What is up, guys? Welcome back to my channel. Today we would be having another equity focused video whereby we would be speaking on Coreweave, an interesting company which had its share price blow up. Literally it went through the roof just this year since it IPO'd, and as we're seeing, it's literally 270% year to date up. So it's a very interesting company, and it focuses on cloud computing, and we're discussing the market cap, how it shot up, and also the risks which are involved and the perils ahead. Please do consider subscribing because these videos do take time to conduct and research. Now, shifting to the Bloomberg screen, we can see the information about the company. The company offers software solutions and cloud services. And also, as we're seeing, the market cap is literally exorbitant. It's past the 77 billion mark. One might question how the share price shot up in such a short period of time. And as we can see here from the revenue did shot up because the company has a 2 billion revenue just last year, and this year it's projected to go to 5 billion, with another more than doubling next year in 2026 to circa 12 billion. Company does remain trading at a loss and is projected to still trade at a loss and is loss making even next year in spite of such high revenue. And this is the red flags, one of the red flags which one has to note. Suppliers, the main ones are companies which are in the tech field, but which is of interest is the customers to whom the company is selling. And as we're seeing here, Microsoft and Meta platforms, including other important businesses, are customers of Coreweave. 62% of the 1.9 billion revenue in 2024 came from Microsoft. And that is of good news, and it can also be bad news, because when you're having literally your revenues depending on just one player, the risks are significantly high. And as we're seeing here, Microsoft didn't just increase the percentage in sales, it also increased the share of the percentage. So ultimately, it's an exorbitant amount which can lead, of course, to problems. The company also has a negative free cash flow, and here as we're seeing, the cash flow is negative, not just negative, but negative by a huge amount, so almost 6 billion down in 2024 and expected to be larger in 2025. And the debt levels of the companies are also very high, so do expect the share price to ultimately reflect these realities because of course the risks are significant. You have a player which is so big and you're relying on that player, things of course can go south pretty quick. Now, moving on to the analysts' recommendations, as we're seeing here, the share price already reflects most of the gains, practically all of the gains, because the share price now is literally trading above all the price targets of all analysts. So ultimately, equity analysts are seeing it hovering around the $72 mark, which is a 55% reduction from the current trading values. The company had an IPO lockup of the shares. When there's an IPO, initially the shares cannot be traded by insiders and there's a lockup period. And as we're seeing here, the IPO lockup expiry expires on the 24th of September. So from the current share price trading at 160, it's 4x from the $40 at IPO. The risks are significant because when you are trading at 4x the IPO price, of course, those who have the shares will be tempted to cash in and make a big buck. So hope you found this video interesting. Please do consider subscribing as always, and also give us the ideas which you have so that we make even more innovative content. I'll see you next time.